experts that are going to be giving you the most up-to-date information from the battlegrounds of writing policies day in and day out. And so we appreciate everybody coming today. As always, we like to start with our mission statement to be a leader in our marketplace by promoting professionalism to our membership through education, communication, and business development. Every time we get together, we always like to focus on that. You can see the objectives. I'm not going to read through them, but just please keep that in mind every time we meet. Every time we meet, not just in this room, but out there doing transactions and creating the commercial real estate market. This is what we're trying to do and ensure so that Sarasota and Manatee counties has a great, robust commercial marketplace. I want to say thank you again to our slate of officers and directors. Those individuals listed on your screen have put an inordinate amount of work in this year. Coming out of COVID, trying to get back to something resembling normal, and just putting all these programs and the events together. We're excited about what they've done. I can't say enough positive things about them, so thank you. Also want to take a moment to say thank you to our sponsors, gold sponsors, Berlin, Patton, Edwin, Sable Home Bank, and Center State. Our silver sponsors, Shoemaker, Luke Kendrick, Synovus Bank, Atlas, and our bronze sponsors, Gulfside Bank, Liquid Range Commercial, Iberia Bank, which is transitioning to First Horizon, right, Rich?
Yep.
And Achieva Credit Union Banking Group. Thank you to all of them. We could not put on the things we do without their sponsorship and the value add that they provided us. We put the sponsorship and program in place has been critical towards delivering the content month in and month out. So that opens up. We're going to have Achieva come up. I believe Sherry's in the audience. And I will turn it over to you.
It's been great knowing that Achieva, being a credit union, has the bandwidth to help us in all aspects. We've got the local support and creating that culture in that community. It was awesome to have Achieva involved from the beginning. They've been such an integral part of our growth and really do understand what it took to make it happen. It's not just about a banking relationship, it's more of a business relationship to the long lasting one. I feel like I'm banking with family. Achieva is banking for good.
Good afternoon. I'm Sherry Kessler, and I'm a commercial lending officer for Sarasota and Manatee County. And what you just saw was just an introduction. That was not actors. That was actually the VP of Business Lending and one of our actual customers out of the Tampa Bay market. So just to give you a little history of the Achieva Credit Union, we started in 1937 with 4 teachers as a teachers credit union. And through the years, we have expanded. We now have over 25 branches throughout 10 counties, from Pinellas County down to Estero. So we're primarily housed on the west coast of Florida, and we serve all members or all people that live and work in our market. So you don't have to be a teacher to join the credit union. So one thing that is different, we operate as a nonprofit since we are a credit union. So we do have some benefits as far as pricing on loans, pricing on our services and our products. And we also have some benefits that apply to us as a nonprofit. So we can turn some of those funds that we use into our foundation and really contribute to the community that we serve. So that's a little bit what we do. I can do anything on the business lending side to help you with your deal, so keep me in mind. We get very creative. All of our decisions are local right here, and I can do anything SBA, 7A, 504. I can do conventional, we do investment properties. Yes, we can do high risk industry. So if you have that restaurant that you really need to get financing for, I can help you because we do things a little bit differently since we do have that local backing. So I just wanted to give you a little bit of introduction and just brought a little surprise. Who's the first person that can tell me what year we started?
1937.
All right, Hollywood.
Thank you, Sherry. Thank you, Achieva, for your sponsorship. Also, want to highlight another one of our sponsors at this meeting is Atlas Insurance. So Mark is one of our representatives as well. To say a few words about Atlas.
I'm going to end up talking too much today. I get a sponsorship moment and a presentation, but My name is Mark Sobolewski. I'm with Atlas Insurance. We are a proud sponsor of CREA. We're a family-owned agency. 1953, we were founded. Rob Brown's our principal. His grandfather actually founded Atlas. All of our owners are locally, born and raised people. We are, not to sound like a typical insurance cliche, but we're small enough to give you that kind of touch. We're big enough to have that broad national reach. That's that line. But we are a proud sponsor. We focus on commercial properties, condos is another big niche, contractors, and some hospitality. It's been great. We do personal lines. It's not where our main focus is, although with what's going on in the market, it's becoming a need for everybody to chip in and get involved. So anyway, thanks for having us, and that's Atlas Insurance. Thank you.
Thank you, Mark, thank you, Alex. All right, I see some new faces in the audience today. If you're a guest, would you stand up and introduce yourself, and or if you're a first-time member coming to the meeting, go ahead and stand up and let us know who you are. I'll bring you the mic.
Thank you, I appreciate it. My name is Sean Alexander with Location Real Estate. I'm based out of Pompano Beach, Florida. However, we live in Avon Park, where we live. Basically, we're part of 3 MLSs, which is essentially Stellar, also Heartland, also Beaches MLS as well. So basically, I serve all the way from Central Florida all the way down to the Keys. So it's a pleasure to meet all of you.
All right, well, welcome. I am proud to introduce Sarah Lynn, who is going to mediate today.
All right, so I have the pleasure and privilege of introducing today's speakers. On my right here is Jason Nestlerode. Jason has been in the insurance business in Florida since 2007 and specializes in commercial real estate insurance with Assured Partners. As a specialist, he helps his clients manage the risks that are unique to their properties by evaluating their exposures to various losses, implementation of risk management strategies that mitigate the financial impacts of future losses, assist with emergency response plans, and selecting the proper insurance coverage based on their risk tolerance. Prior to entering the insurance business, Jason worked in real estate for Lennar Homes. His passion is music. He plays guitar, saxophone, and other instruments, and has a Bachelor of Science degree in music education. Assured Partners is the fastest growing independent insurance agency in the United States, with offices in 38 states and 2 countries. One of Assured Partners' largest areas of expertise is in the commercial real estate sector, and they currently insure over $250 billion in property values throughout the United States. And then to his right, as you've already started to meet, is Mark Sobolewski. Mark joined Atlas Insurance in 2018 after graduating from the University of Florida with a Bachelor of Science degree in sports management. Prior to finishing his undergraduate studies at UF, he played baseball collegiately at the University of Miami and then professionally in the Toronto Blue Jays and Minnesota Twins organizations. Mark grew up in Sarasota, Florida, where he met his wife, Danielle, a kindergarten teacher at Southside Elementary School. Mark has enjoyed mentoring young athletes as an assistant coach for the Sarasota High varsity baseball team since 2016. All right, take it away.
Everybody's bio sounds so nice. When you hear it like that, it's like, oh, I'm not so bad. We're doing some good things in there. Thanks again for having us. I know everybody's favorite topic is insurance, right? There's like no applause, hardly eye contact. We're all ashamed. All right. We're going to give you an overview on a number of topics. So we'll just get right into it here. First of all, the bad news. The general market conditions. Anybody that's had a renewal of any kind lately has experienced quite a few price increases, reduced terms, all types of bad things. We were making a joke when we came in, hey, you're going to get us down to the 2012 rates again, right? That's going to be the main topic or the point of today. I don't really have that magic wand, unfortunately, but let's talk a little bit about the state of the market. We are in a hard market. What that basically means is we're seeing carriers leave the state. We're seeing more and more litigation that's piled up over the years, increased costs. We're just seeing everybody suing each other. We're seeing more catastrophic events. It's an accumulation of events that have led to a very, very difficult insurance market. We'll be more specific in future slides here. So when you talk about a hard market, who does it impact? Basically everybody. It doesn't matter who you are. If it's a homeowner's policy, we're more concerned about the commercial end of things here. But whether it's a property that's brand new or on the key and on the water, that's joisted masonry construction, everybody's going to be impacted to one extent or another. Now, are some options better than others to these carriers? Of course. Think of it a little bit about if your money was at stake, if your money was on the line, who would you want to insure? You know, a frame home out on Siesta Key or a newly built shopping center east of 75 and Lakewood Ranch. That's what these carriers are doing too. They're looking at it that way. So it's going to affect everybody, but obviously the newer the construction, the further you are away from the water, the better. What does it mean for property owners? Well, everybody had a few handouts, correct? Okay, so let's go to, if you could, go to your premium comparison. I'll go to mine as well. This is actually from a client of mine. We just went through this process about less than a month ago. So if you look at the premium comparison handout, you've got an expiring premium section, and then a renewal premium. So there's a difference of $4,700. Same building, same tenants, nothing's changed, same ownership. So why the difference? That's a pretty decent chunk when you look at it, right? What's not included in this is on the left-hand column, that expiring premium included a 2% wind deductible. 2%. The one on the right is a 5%. So I'll save everybody the math. This is a $2.4 million property on Hillview that you all probably driven by quite a bit. It's $2.4 million, 2% wind deductible. It's about $48,000. In the event of a wind loss, say a hurricane comes in, wipes it out. $48,000, they'll pay for the rest of the $2.4 million to rebuild it to the same like and kindness. 5% is about $120,000. Now, the odds are you're not going to have a total loss, right? However, in the event that you do, not only did you pay the extra $4,700 to insure it, but then you got the extra kick in the butt with pay us an extra, pay us $120,000 versus just under $50,000. So this is a really good example of a hard market. Worse terms, increased premium. Let's go to the other handout I gave you. This is going to be the marketing summary. Thank you. So this is another client of mine. Little background here. This was a very interesting guy. He owns about 12 good-sized properties from here up to Tampa, mostly industrial warehouses. He has a really cool business. I don't want to give him away. There's not many people that do what he does. He's got a business that insurance companies don't want to insure. What he handles catches on fire very quick and it spreads. Okay, but on the side of the business, he's got many commercial properties. So I insured him last year. I was able to help him out. This is the marketing summary for this year. And if you look at it, you've got a $15,000 figure. That's going to be for all other perils. Who knows what AOP stands for? Look at Henry. Perfect. I don't know what price to give you. Throw one if I did.
What's an example? What's an example?
Everything that's not covered by liability or property.
Wind.
Other than wind, yeah.
Other than wind, basically. So fire. Think fire. So this is a $3 million property. $15,000. Anything except wind is covered. Go down to the bottom. It's highlighted. At least on mine. Is it highlighted on yours? Okay, good. So $36,000. That's just for wind. That's just for wind. But more importantly, look at all the decline. Look at the reasons. Must be sprinkler. Well, it's an industrial warehouse built think this one was built in 1972. It's not sprinkler. Value exceeds maximum limit. They have different appetites. They don't want to go for $3 million for this type of property. Prohibits woodworking. Okay, again, type of business. Decline due to age. Can't write wind only. Look at how specific their appetites are getting. So as the agent, and Jason's dealt with this quite a bit. As the agent, you can be a hero or the bearer of good news in a certain market, and then you're kind of the person that has to deliver the bad news and what's going on today. And so this is really a good example of what we're seeing if your property isn't newly updated, newly built, just top of the line, away from the water, all those things. Last handout, I promise. Nobody likes paper anymore, but I promise you. So this is a very, very good layout of why we are in a hard market. And without reading it to you, essentially it's breaking down losses, catastrophic events, different things that are occurring throughout the country. And everybody thinks, well, I own, say you own a couple of buildings in Sarasota, Florida, never had a claim. I get that all the time. I've never had a claim. Why is my insurance going up? I'm a great owner. Well, that is true, but there's a law of large numbers. The whole country, events in the whole country affect the insurance market. Reinsurance rates are affected by it. Fires in California are specifically labeled here. Fires in California affect insurance premiums in Sarasota, Florida. The winter we just had in Texas. The winter we had in Texas, which is uncharacteristic, all those losses, that affects the insurance market. So this is a really good illustration of at least part of why we are where we are. They get into on the back side of it, where it says times are changing. It does get into what's going to turn the tide, and I'll get into it a little bit later. But it's not an exact science, and nobody knows 100% for sure. All right, so how do we operate? I've given you nothing but bad news. We're in a hard market. There's not a lot we can do. Well, a couple things that we can control. We have to plan and prepare. So I'm labeling that more from the insurance agent side of things. It's our job, if we're doing our job, it's our job to take the risk management off your plate. And one thing we can do is give you a heads up. No matter what your role is in the real estate business, no matter what it is, we want to give you a heads up. Hey, I know your policy was just written 10 months ago. This is what we're seeing in the marketplace. Hey, I know you're thinking of buying this one. You need to look at your budget. It's up to us to be trusted advisors, not just people that sell you a commodity and then hit the road, get on to the next one. That's really not doing our job as agents. Okay, we want to be advisors, and I know Jason is, and we try to be as well at this. Submission quality. Think about it like this. The agent is basically representing you in the marketplace. Okay, so if an agent takes your information, is this building, it was built at this time, and it has these features, submits it. It's not terrible, it's not illegal, it's not the worst, but what if the agent really represented you to the carrier? What if you said, hey, you need to learn about the owner. This is his background in real estate. This is what he owns. These are the businesses that he ran. This is what he expects from his tenants. This is how he updates things. This guy doesn't cut any corners. Give a submission. That would be in our industry what we call a top of the stack submission. Something that an underwriter gets and says, hey, this is a good risk, because we're all risk. But you need them to say this is a great risk. I want to write them because they don't have to. They look at all the decline. They don't have to. You want to submit it and make you want the agent to make you look as good as possible to the insurance marketplace. Deductibles. So, there's those AOP deductibles that Henry was all on top of. The wind is what affects the premium, and that's what everybody ultimately cares about. We care more about the coverage sometimes than the property owners, but the wind deductible, 2, 3, 5 usually, that's where the premium is affected. It's not going to be affected on the AOP side. very, in the grand scheme of things, it's this much. Okay, so we got to play around with deductibles. During a soft market, a lot of the conversations involve, can we get you down to a 2% deductible? Now it's a harder market. Does it make sense to get us up to 3 or 5% to save some money? Everybody's got a different appetite for that. Market, and that goes back to that marketing summary page. The one challenge in the insurance industry, I would say, a lot of us have access to the same carriers. Not the exact same, but mostly the same. You got to make sure that your agent or agency is doing what you hired them to do, or is doing what they're saying they're doing. It's very easy to say, oh, I went out to market, this is the best we have. This is the best we have. Might be true. Prove it. If they're not going through a proposal that says I went here, they can only do so much as far as the response. You may not like the final answer, but they ought to be able to say, I tried everything, especially in a hard market. In a soft market, sometimes it's renew it, there you go. Done, simple, easy. In a hard market, show your work. My wife's a kindergarten teacher. Well, I don't know how hard the math is. It's probably harder than when I was in kindergarten, but if you're missing it, if you don't like the answer, at least can I see what you tried? I mean, some of this is an effort deal, right? So anyway, marketing is another way to try to combat the hard market. Oh boy, when is that? So the scientific answer is hopefully 2 to 3 years. Nobody knows for sure, but what ultimately has to happen, insurance companies that we all love, they have to feel good enough about their profit margin. So a lot of them typically operate on a 95 to 97% combined ratio. They take that 3 to 5% profit, they invest it. That return is what they're making the big bucks on. So a lot of it depends on how they're doing on investments. Now, what happens is if they get to that point where they're doing better and better, well, how do we know that the market's softening? You're going to see more companies coming back into the marketplace. So an example, I keep going back to that joisted masonry structure on CFCT. Whereas, maybe this year, 1 or 2 companies wanted to write that piece of business. Maybe in 2 or 3 years, all of a sudden it's 5, 6, 7, 8 companies want to come in and write it. What does competition do? Drives the price down, right? It's not that hard to figure out, but that's sort of what you look for. You start seeing signs like from the insurance agent side of things, you start seeing signs of, we didn't have that option a couple years ago. Now they're back and like, that's interesting. That carrier, they left the state of Florida. Now they're coming back. Well, why is that? Marketing, market soft. So that's kind of at least part of what we look for, and we hope it's sooner than later. Oh boy, I've heard enough about this. It's like about the Delta variant. No. So a couple things about COVID, the insurance agency or insurance side of things, but how do carriers react? They kind of sat around and I think all are different, so I don't have the perfect answer. Jason can probably elaborate too, but what I would say is they sort of sat and watched to see how the world reacted. It's kind of like every industry. The one thing to note, you probably all experienced to one degree or another, were claims covered? Basically no. And the technical reason is business interruption is going to be where you would have found coverage. Business interruption is a property coverage that has to be triggered by a covered peril. So if you have business interruption or loss of rents or any extra expense, you had it, that would come into play if the building was physically damaged, fire or wind. Okay, so we didn't have a fire or wind event. We have a virus. So the carriers were able to deflect a lot of this and say, although it sounds like your business is interrupted, so why isn't business interruption coverage addressing this? They were able to get out of it. Now there's one example, it's a well-known place in town that has a lot of trees and bushes. Okay. They had an old school policy, and there was an infectious disease endorsement or verbiage in there that allowed them to get a nice piece of money back because of COVID. The second they got that payout, the second they had to renew, guess what piece of language was gone? That thing was gone faster than you can believe. So it's a tricky thing, but it's the key to remember is hopefully this one is hopefully done with, but two, you always have to figure out like what triggers coverage. In this case, it's a property coverage. You need property damage to get the coverage that would have been in place through business interruption.
And one other kind of caveat that happened last year as well, with that was, aside from just the direct loss to the building, most insurance companies have a virus and communicable disease exclusion in the policy that completely bars coverage to begin with. So that's why a lot of these folks ran into some issues during COVID last year when they were trying to file claims against their property insurance to get reimbursed for those, for that loss of business income.
Thank you. Okay, on to new business. So this is always, this can always be a challenge. So insurance, the world of insurance doesn't operate at the time frame of maybe other businesses or lines of work. You know, the sooner we get an idea, like if you have a client, you're going to reach out to an insurance agent, or they need to reach out to an insurance agent. The sooner we know about it, the better job we can do, 100%. We go back to that marketing and try to create a pretty picture, paint a picture of this person, get the best terms and pricing possible. We need time to do that. And not so much us. So you can have the most ambitious agent, Jason, Mark, we're the most ambitious agents you've ever seen, right? You can have the best agent, but the carrier, we're not the ones making your quote. We can't give you a quote. I can go to market and get the quote. They need time. They're bombarded, especially depending on the time of year. They may have a stack this big on their desk they have to get to. If you call at 3 o'clock on a Thursday and say, hey, we're closing tomorrow. Can we push? Push as hard as possible. Do everything possible. Do you like to write business? I like writing business. We'll do it. We'll do everything possible. However, realistically, they don't like it. It is tough on us. And we can't do a thorough job marketing the property, the client, whatever it may be. So the sooner we know about it, the better. And that's the biggest point, if I can drive that home. Drive that home, earlier the better. So yeah, I mean, a standard idea would be a week to 2 weeks. 2 weeks is really nice, but the sooner the better. All right, the renewal process. So the way we look at it is we want to make renewals a non-event. You know, if you're no matter what kind of business we're insuring, if you do a good enough job throughout the year, it should not be, oh my gosh, what happened? We have 5 days until my policy renews or cancels. What is this? This is the first I realized that we're up 35%. Well, whose fault is that? It's the agent. Make it a non-event. Be in touch with the client throughout the year. Give them updates on the market. Give them updates in terms of what to expect. Give them updates in terms of what carriers are maybe a better option this go around. It comes down to communication. A lot of times we'll provide client service calendars at the time that you actually sign and get your first policy in order. But a client service calendar is a nice way to do it, just because there's no wiggle room. We promise we're going to meet and talk about this. It could be quarterly, monthly, whatever it is. A lot of times, I know I work best if things are on schedule. Quarterly checks, mid-year stewardship. Mid-year, you want to definitely meet and say, hey, are we doing the right things to satisfy your client? If not, let's fix it right now. A lot of times that's when the question gets asked, what do I need to do to keep your business? And they'll say, we'll keep my premium down. And then that's maybe not the sign of the best client, but I get it. Submissions, we submit everything as soon as possible. We want to, in some cases, try to take care of certain markets. Quotes 30 to 45 days out. That's sort of industry standard, probably more like 30, but we like 30 to 45 days, and it's proposed no later than 2 weeks before renewal. That way, when you propose a new renewal policy, if you need to make adjustments, which of course you will, you have time to do something about it. And then binding and policy drop off. We still like to drop off policies in person. All right, I'll hand it over to Jason. Thank you.
Thanks, Mark. Yeah, a lot of good information about kind of what's going on right now with this all the insurance markets. And one of the things that Mark mentioned was a lot of us insurance agents have access to the same market. So my recommendation is just make sure whoever you're working with is great, that knows what they're doing, that's experienced, and can help you kind of through some claim scenarios that will really identify those things for your clients. As I like to say it, basically, sometimes, you know, you've got the right horse, the insurance company, but you got the wrong jockey, the wrong insurance agent. So it's just a matter of working with someone that you're comfortable with, you like to trust, and that understands the business. So what I wanted to do, the way I kind of organized this, Mark and I organized this for you, is to kind of cover what's going on in the market. I'm going to try to cover basically what we're looking for whenever you're bringing one of your clients to us to help them with their insurance. So I set up a few different situations. Basically, the first one is going to be for landlord property insurance. So you're the agent for the person that's actually buying the building. So what we're usually looking for to help us tell that story to the insurance company are things like an appraisal that have replacement costs. There's two different kinds of appraisals. Sometimes the bank will do a market value appraisal, and sometimes they'll do a replacement cost appraisal. We're interested in what's it going to cost to actually replace the building itself. Replacement cost estimate of what their contents are going to be. That's something that usually the business owner has to come up with to kind of give you a good idea. Rent roll, we're always looking for this, especially if the building is leased. And the reason for this is where we get the information on your tenant, but also what they're paying in rent, so we can calculate the rental income coverage for the person that owns the building. Also verify the occupancy, and then a big thing are updates. So in particular, if you have an older building where you know, nothing's really been updated in several years, you can have some issues. And really what we're looking for are when were the updates gears to the HVAC system, the electrical, the plumbing, the roof, because that's going to allow us not only to negotiate the best rates from the insurance company, but it's also going to give us access to more markets, because some insurance companies won't even quote if the building hasn't had updates. And then we get into an area where you can basically get additional credits to help keep that premium down. One is if they had a wind mitigation inspection. Usually this happens if they've replaced the roof recently, say in the last decade. There's credits that are available that some insurance companies will offer on commercial properties if you have a wind mitigation inspection. Usually check with the prior owner or the current owner of the building that's selling it. They'll usually have a copy on file if that's the case. We want to verify that the building has a sprinkler system or not, because this is an additional credit. And then also centrally monitor burglar and fire alarm system and the lender's contact information. The reason I say lender's contact information and not the mortgagee clause is because Mark and I will do that legwork for you. So we're going to engage with the mortgage company, and we're going to get all the information that they need for the loan, and get the insurance information to them. So that's one thing that we'll be looking for. Now, if you're representing the tenant, a couple of the things that we want to know, obviously, are operations. You know, what's the tenant doing in the building? Because this is what's going to be important. Copy of the lease. What this is going to do, Mark and I will take a look at the lease, and it's actually going to lay out the insurance responsibilities within the lease. So who's responsible for what as far as tenant and landlord? And it's a huge part of how the policy is written. So we need to make sure that we have a copy of that so we can review all the information that's in there. How much square footage are they occupying? This is going to be key for the general liability insurance. Building update years, again, we're still going to need to know the HVAC, electrical, plumbing, roof, and then replacement costs of improvements and betterments. So what this is not the building itself necessarily, but it's all the improvements that whenever a tenant decides to move into a property, all the build out they're going to do to the interior, typically they're responsible for that. So what we want to do is make sure that we include insurance to cover that within the policy. An estimate on what their business income and extra expense costs might be. So this is going to be if they were out of business and shut down for say 3 months, 4 months, 5 months, what does that look like as far as what they would be losing if they had to shut down the business for that amount of time? So those are the kind of things that we work with. And another thing we can offer is a business income worksheet, because a lot of people don't know how to figure it out. And what I'll do is I'll actually sit down with folks and we'll go through the worksheet together to kind of break everything down so they know what their actual limit should be, because there's a lot of policies that are out there right now that people don't keep up with the business income. And it can be complex to figure out. So some people don't even bother with it. They just come up with a number in their head and it's completely off. So it's worthwhile to sit down and actually go through it with an insurance agent. And again, does the building have sprinkler systems, centrally monitored burglar and fire alarms? And especially on the burglar alarm, this can create an issue for tenants sometimes, because if they don't have one, there are some insurance companies that will exclude that coverage. So that means that all their contents that are on inside won't have any coverage against that. So something that's very important to consider there. And again, this is information that we just ask you to have to get to us from your client, or at least let your client know this is what we're going to be asking for. We're not getting too deep into the different coverages and everything else, because that's kind of our conversation to have with your clients. We don't expect you to go out and try to explain the insurance policy to them or the process. So owner-occupied buildings, we covered, okay, we bought it, we're a landlord, we're leasing it out. We covered the scenario where, okay, you're representing the tenant and they're going to occupy the building. But what about whenever the person buying the building is also going to occupy it? We have to kind of break this apart. We want to know how it's being structured, because what a lot of people will do is set up an LLC to actually hold the real estate itself, and then their actual operating company will occupy the building. And in that scenario, we just need to know, are they buying the property in the LLC, or are they buying the property in the company name? And this can be a big issue, because what ends up happening is if they buy it in the company name, then we're not only considering the premises liability, so slip and falls, things like that happen on the property, but we're actually also taking into consideration what their operations are. Are they selling products that they need liability coverage for? We're going to actually build that all into the same insurance policy. Whereas if they were set up as an LLC holding the real estate and the operating business occupying the property, we would actually have two separate policies, because they're owned by two separate entities. So it splits it up a little bit more, and it's a clear delineation of who's responsible for what. There's no wrong way of doing it. These are just the two options that we most typically see and how we handle them. Builder's risk insurance. This is something that comes up a little bit. Anytime your tenants are, you have a tenant building out, either renovating the interior of a property, or if you have a developer that's actually building the property itself, or an individual that's building the property, there's two different types of policies you can get. There's basically a builder's risk renovation policy that what it's going to do is cover the actual renovations and materials that are being waiting to be installed on the property. And the other option is ground up construction, where we're going to insure all the materials and everything on the site. So with that, there are some policy length options. I know we've had some communication about this with a few folks in the group previously, but what's the right time amount? Because you can actually buy a builder's risk policy for 3 months, 6 months, 9 months, a year. It doesn't have to be a 1-year policy like most property policies are. And the biggest thing right now, I think, is, which one do you buy? Well, how long is the projected project going to take? That's the first step. But also, what's the worst case scenario? And what I say, especially right now, people may be wanting to consider a little bit longer time frame in the policy, because just the distribution disruption that we've had over the past year of building materials. We saw with lumber that's finally starting to come down a little bit more. But it's tough to get materials, and it's more expensive to build and rebuild property now. So and the time frames are being stretched out as well. So there's some things to kind of keep in mind. I would err on caution as far as doing a policy that's shorter than 6 months. I think between 6 months and 12 months, you're probably in a good spot for managing most projects. Flood insurance. You want to cover this, Mark?
So you've got a couple options. You've got your federal program through FEMA, and then you've got the private market. The best way to kind of compare them, the private market is a little bit more volatile. You also have options for higher coverage limits. So the federal program, NFIP, you can go up to $250,000. There's probably a way to get up to 500, but it's a little bit different. On the private end of things, if you need higher limits, the private is probably your option. Now, a couple of things, there's a waiting period on each, meaning if you go with the federal option, there's a 30-day wait period, meaning if there's a flood event in 30 days after the policy is in effect, that's not going to be covered. Now, on the private end of things, it's typically 15 days. So you have a little less of a waiting period, which is a good thing. Generally speaking, NFIP has been in the red quite a bit. Just something to keep in mind. They don't typically do very well. We've seen the private market sort of come back and be a little bit more competitive on price. There was a time where that road was not really an option. I'm not sure if they're on. Okay, then another thing with the private market, you actually have an option to include business income and loss of rents. That's very important to a lot of commercial property owners. Now, on the NFIP side, that's not going to be an option. So there's two different ways to look at it. It's private, the federal market. It's worth exploring both, depending on the type of property that you have. Okay, so hurricane season, we're smack dab in the middle of that. Everybody that's been around Florida for some time, they get the idea of like the storms bearing down on us. What do I do? Should I be prepared? I'm not going to go into how do you prepare for a hurricane. Hopefully we all get that or have a neighbor that gets that. What ends up happening on the insurance side of things, there's essentially a deal that these companies don't want to pay claims that they don't have to. So there's an adverse selection effect. Once you're in the box, they call it like the box, 16,000 square foot box. Once a tropical storm or hurricane is getting into that box, you're going to see what they call a moratorium or binding restriction or binding freeze. This came into effect recently with Elsa. That was this year. Elsa was bearing down. I had a client of mine, and his building was coming up, and this is probably on a Thursday, Wednesday or Thursday. Policy was coming up on Wednesday, and I'm going back and forth with them. We're at the very end. We're trying to figure out little tweaks to deductibles, last little changes. Then all of a sudden, and then there's actually two carriers involved. And then all of a sudden, I called them and I said, hey, we need to make a decision. But what happened was we got the notice from one of the companies first. They said, hey, just so you know, we're going to stop all binding 6 a.m. Friday morning. Nice. Thanks for the heads up. Well, we knew it was probably coming, so it wasn't a total surprise. But what happened was we had to say, it's time to make a decision. The last thing we want to do is go into this. We don't, hopefully it's a big thunderstorm, which it turned out being, but we don't want you to go through the storm without coverage. And so that's what ends up happening. This storm gets closer and closer and closer. You gotta pay attention. Well, it's our job as agents to pay attention for you on the insurance end of it. But they'll end up stopping binding. You can't get any new business written. And the worst thing would be to be an agent thinking everything's going to be in place, and then the insurance holds you up because what? Well, hurricanes coming through. Think of the time of year, June 1st through November. It's that time of year. So again, we'll look out for that.
And really one of the big things is too, whenever there is a hurricane or major hurricane that people think are going to come through, you'd be amazed at the amount of people calling us to try to get flood insurance. And as Mark mentioned, there's a 30-day wait on floods. So you can't wait until you know a storm's coming to buy it, because you're not going to have coverage during that time. Even if you pay for it, sign the application, it doesn't make a difference. It takes 30 days to actually take effect. So, and one other thing on the flood too that I just wanted to make a point of, with private flood and NFIP flood, the National Flood Insurance Program, the one big thing to be careful with is if you do have a client that wants to go with private flood, sometimes they can lose grandfathering into the NFIP. So if they ever decide to go back, the rates will be much higher than what they were when they previously were with them. So just something to keep in mind. Appraisals, this is a big thing that I want to kind of get on, because I see it all the time where, especially if there's no, it usually happens when there's no bank involved, there's no lender involved, it's a cash deal. Appraisals aren't always ordered, at least not replacement cost appraisals. And just with all the stuff that's going on right now, like I said, with the distribution change and prices of everything going up, inflation, even though there's not necessarily a direct correlation between what it's going to cost to replace the building and what the market value of it is, there's a range where it kind of follows sort of in the same direction. So just be careful with those things. And I would recommend, having the appraisal updated every couple of years at least. I know what happens a lot of times is people will get an appraisal done, they think, all right, I know what the limit is I need to insure it for, and that's what they keep on their policy for 10 years. So, and as you all know, cost of construction goes up, everything goes up, it's not going down. So they're going to end up in a situation where they could be seriously underinsured. And where that problem really comes in is when you have a claim, obviously.
On construction type.
Yeah.
So if you currently have a frame building, but modern code says you're in the flood zone and you can't have frame on the first floor or something along those lines, how does that work with your claim and your insurance? Are they only going to build back for a frame, or can you write the policy such that they reconstruct a modern code?
As far as reconstruct a modern code, where that usually comes in is a place called ordinance with law coverage, where if the building is damaged more than 50%, usually a code official will come in and say, you have to rebuild to the new codes now. So whatever the codes were in the 70s that you built it to, where you weren't making any renovations or anything other than doing building updates, you're kind of grandfathered. But as far as if the building ends up being damaged 50% or more, then code officials can come in and maybe tear it and rebuild to new code.
So that's where your replacement costs, you have to do the replacement cost on whatever, or you should be forecasting the replacement cost based off of the current code, not rebuilding.
It's somewhat, yes. Again, the appraisal, the one person actually doing the appraisal is the one versed in that, so they'll kind of know how to establish that because they're used to establishing insurable replacement costs and putting that in their appraisals. So,
The insurance company, what are they going to pay?
I'm sorry?
The insurance company isn't going to pay you for the new codes, right?
Well, that's where you have to, there's an endorsement that we would work with the client on, especially if it's an older building, where we would have them purchase an ordinance or law endorsement. And what that does is it will typically, the way I structure it, is it'll cover the undamaged portion of the building that has to be torn down and rebuilt. But it will also pay for the debris or the demolition cost and also the building up to the current codes. Usually that's a percentage. They'll give you like 10% of whatever the building value is towards additional codes.
By the way, nobody ever wants to buy that.
No, it's expensive.
You try to explain O&L coverage, and they look at you like, oh, yeah, you're just trying to, no. See, that's a great question. You should. It's really worthwhile.
So I have a question. So if the insurance company is looking at the building, the new codes, let's say for instance, we buy the building, we have the new codes, everything updated. 2 years later, the codes change. How often should we, as a person buying the building, how often should we look to those codes and keep above or keep ahead of it so that we don't get caught with the codes being changed because it's not up to date?
I mean, I wouldn't, and Mark can comment on this too, but I wouldn't get too much carried away trying to figure out the exact number. I leave that up to the appraisal company because they're going to factor that in. Yeah, there are big major building changes, and yeah, you'll need to take a look at that, but it's not something that you're going to need to look at every 1 or 2 years or something like that. It's whenever you're getting the appraisal updated. So and usually, just to kind of give you an idea of when you should get appraisals updated, we could even take Florida condominiums and how those are handled. Any condominium association in the state of Florida is required by statute to update their appraisal every 36 months. So every 3 years. So I kind of use that as a gauge as far as what I would do with other commercial properties as well.
Is that only residential?
It's typically, it's mainly residential for the actual statute. It's dealing with commercial residential condo associations.
I mean, that's another good reason for your insurance agent to be in touch throughout the year. You shouldn't lose contact because they should be getting information about, if they focus on property, commercial property, if there's a big change in code, that ought to come across our desk.
Yep.
You say changes with the disaster in Miami with the collapse of the building?
Yeah, we'll actually get to that. I've got a slide on it coming up in the future, actually. So I'll get to that in just a second here. But just to hit on this real quick, with appraisals and the replacement cost and everything, there's still a co-insurance. I call it a penalty. Some people call it a co-insurance clause. I call it a penalty because you typically, if you don't make any changes to a property insurance policy, it's going to have 80% co-insurance. And what that means is at the time that you have a claim, the limit that you are carrying for insurance has to be within 80% of what the replacement cost is on that day. So it can create some issues because what some agents will do is they'll even change that 80% number and they'll make it 90% or 100%, which is even worse because what that would mean is you have to make sure that your building is going to be 100% of the replacement cost when you have that future claim, when you don't know when that's going to happen. So the way I fix it is a lot of times you can buy what's called an agreed value endorsement on the policy, which means that regardless of what the replacement cost is at the time of claim, you're insured for that agreed value. They're not going to deduct anything. They're not going to say you need to be within 80%. It gets rid of that provision and pushes it aside so you don't have to deal with it anymore. And sometimes that there's a little bit of an additional cost with it, but to not have the headache later on, I think it's worth it. But usually carriers will want an appraisal, so that's another reason why you should really have one to get that agreed value endorsement.
What do they do in case where they got things like foundation issues and so forth on the physical building for the property? Or is it they not seen those? I'm not talking about the land, I'm not talking about the other types of buildings. That goes into play. So if you look at it, they've got cracks and everything along the foundation. What's happening with these buildings? How does that play out into the appraisal process? The appraisal value?
Well, through the appraisal process, there's going to have some problems. But the other thing is the insurance company, after they write a building, they're going to go out and do an inspection. So if there's serious structural issues that they can see, they're going to note that. They're going to either come back and say, either fix this or we're canceling you in this amount of days.
They will.
And they will. So that's kind of really where that comes into play, not necessarily the appraisal company. We'll do a little Q&A at the end as well, just kind of address any other questions. General liability insurance and umbrella liability. So, why does it sometimes seem so expensive when a tenant is just leasing a small office? Like sometimes that comes back and you get the insurance and you're like, why is this so expensive? So as I mentioned before, in addition to premises liability, so covering your slips and falls on the actual premises, we're also insuring the operations and products and whatever that business does on the general liability policy. So all that exposure is getting wrapped in now, and because we're insuring those other pieces. So usually what happens is the tenant has a business that's already set up that they're just adding a location to or something, then they can usually just add that onto their existing general liability policy. Unless it's in an LLC that's separate, and then they need to buy a separate policy. So that's kind of where that all comes into play. And then umbrella liability, again, we don't know how big claims are going to be. So that's your catastrophic protection in case you use more than $1 million in your general liability insurance. So if someone slips, falls, cracks their head, has permanent damage, that lawsuit's going to get expensive. So limits, speaking of that condo and search side, how much coverage should we buy? How much, when I buy a property, how much coverage should I have for liability? Well, depends. How big is the claim going to be? That's what I always ask. I know that's kind of joking around, but because none of us know how big the claim is going to be in the future. You take a look at Champlain Towers and Surfside, and nobody that's living there knew that was going to happen. Yes, did they know that they had, $10, $15 million in repairs that they should have been doing? Yes, but nobody expected this. So from what I read, I haven't seen their policies, but just from what's been in the news and everything, it sounds like they have about $15 million in liability coverage. There's probably 150 families that were lost in that. So how do you establish, again, that's just a prime example of, I don't know how big that future claim is going to be, but the idea is that you want to at least establish some kind of minimum limits, and then also just be aware of what the asset size is and what the building or what the business owner owns, because that's going to come into play as well. And every different scenario is unique. So that's something that Mark and I talk through with clients on. Certificates of insurance. So this is probably a biggie for you guys, because especially lenders, because that's what they're always looking for. What this does, basically, if you have a client that's a landlord and they're going to be leasing out the property, you want to collect a certificate of insurance from the actual tenant themselves. And not just a certificate of insurance, but we'll talk about a few of these other things. We'll get lease requirements together, establish requirements for vendors, certificate holder versus additional insured. We'll talk about a little bit in these next 1 or 2 slides. Waiver of subrogation and 30-day notice of cancellation.
Question.
Yeah.
Can you explain go back to the previous slide. What's the difference between the certificate holder and additional insured?
Yep, we'll get to that right here.
I'm
Basically,
sorry.
no, you're fine. So if you're just a certificate holder, okay, let's say you're not an additional insured on someone else's insurance policy. So if your tenant just sends you a certificate of insurance, doesn't say you're additional insured or anything, what that means is they're just showing you that they have group insurance. That's it. When we add that additional insured endorsement to their policy, to the tenant's policy, that now means that the landlord is also covered for liability that arises out of that property based on the tenant's operations.
Side point, if you run a brokerage that also does property management, if you want to have your leases, say that not just the landlord, but the management company is
100%.
also additionally insured. Otherwise, it'll be your liability insurance that covers that, and it opens you up to risk. So we talked about leases last month, but that's another one of those things that's insurance related that you want to make sure.
That's a very good point. Thank you. But yeah, you want to make sure the property manager's involved because obviously they're handling the day-to-day for the insured, so they have exposure as well. Waiver of subrogation endorsement. Some people require this. I don't get too much into this, but basically what it means is if your tenant has a claim and their insurance, they file under their insurance, and they decide, their insurance company decides that, well, you were partially, the landlord was partially at fault, so we're going to go to the landlord's insurance policy and ask them to reimburse us for whatever their contributory part of the negligence was. So what the waiver of subrogation endorsement does is if the tenant puts it on their policy, it means that their insurance company can't come after the landlord's insurance now. They can't come for reimbursement. 30-day notice of cancellation. This is another endorsement that we add onto the policy that will notify the landlord if the tenant's insurance either cancels or they're going to cancel. They basically tells the landlord that the insurance company will let them know 30 days ahead of time if there's going to be a cancellation. So then vendor recommendations, this is the other part where certificates of insurance can come into play. So whenever you're hiring vendors for your landlord, especially if you're a property manager, make sure that you're giving a certificate of insurance for them as well, with the same 3 things that I mentioned before in the last slide. Because what this does is you want to make sure that you have an indemnity agreement in the contract that's in your favor. Because all insurance really is basically, it's the transfer of risk to the insurance company rather than keeping it yourself. So the insurance company, it's all built around indemnification. So what the indemnity agreement does is it tells the contractor, okay, if these things happen, then we'll indemnify the landlord because it was our fault. And then their insurance, the purpose of that is to fund that indemnity agreement. So they would make a claim against their insurance carrier to fund the indemnity if they were liable for something. And establish minimum limits. I mean, I'm not going to tell anybody what limits their contractor should be carrying, but I would structure it as some of the lower risk things, like say someone's going in to do a $6,000 or $7,000 paint job. It's different than if someone's going in and doing a total like $100,000 renovation and knocking out walls and everything else. So my recommendation for anybody is that the vendors carry at least $1 million per occurrence limit. And that's usually pretty standard what people carry. And what's funny is, that limit that $1 million limit that everyone started carrying They started carrying that in 1984 when the insurance industry started doing that. So no one's really changed what limit people should have. So they're carrying the same $1 million in 1984 that they're carrying today. So that's something else to think about whenever you're establishing what your minimum limits are. So that's why I recommend at least $1 million. And again, I just talked about that, the guidelines type of work. So paint job versus they're doing a bunch of demolition. You should require higher limits from the demolition company than you would for someone doing a small paint job. Mark's going to talk a little bit about vacant land.
Best way to go through vacant land. I know at Atlas, we had a claim a few years ago before I started. One of our owners had a client, they were a hotel, a nice hotel, and then they had a nice plot of land. They were still contemplating really for years what they're going to do with the land. And then next to the land was water. So the land was enclosed by a fence. It was perfectly marked, big sign reading no trespassing. Friday night, a couple of high school kids are having fun. You think they listened to the fence or the sign? No. And they also brought a case or two of something else over the fence. Fortunately, kid ends up drowning. So it's a terrible event, number one. But on the insurance side of things, this is the kind of policy that a vacant land, that's the kind of event that vacant land would cover. It's a general liability driven premium, relatively inexpensive too. But you think about some of your clients that have properties and would it make sense for them to have? Absolutely. If they've got a plot of land, they haven't done anything with it yet, and there's plans to maybe do something, but it's theirs, you're protecting yourselves from somebody doing something maybe they shouldn't be doing. But also it could just be people, walking through the land, any type of third-person property damage or bodily injury.
Things that can kill a deal. We're gonna end with this. So these are just some items that can come up where they're going to cause issues for any insurance company to insure the property. Biggest one is that there's existing property damage. This is a big issue. Insurance companies literally have wording within their policies that say we won't cover any existing damage on the building at all. But not only that, usually it's an underwriting issue. So if they're going to inspect the property, if they go out there and take a look at it, and the insurance company is, there's existing damage, you're going to have to take care of it. They're going to require you to, or they're going to cancel the insurance. So that's a big one. Age of the building, the older that you get, especially if there's been lack of maintenance, lack of updates to any of the major items, especially the roof. That's usually the biggest one. And then you combine that with distance to tidal water, you're shrinking the amount of insurance companies that will actually consider writing the risk. And then previous losses to the building. If there's been any major losses previously to the building, that can cause insurance companies to kind of shy away from it, or the rates to be super expensive to the point where it's not affordable for the person that was buying the property as an investment to invest that additional cost into the deal. And so we'll leave this open for questions from everybody.
Let me grab one. Sure.
We turn one on.
Questions, anybody?
Yeah, when I'm getting a certificate of insurance, from the tenant, the landlord, very often at the top, it lists the tenant's name and his home address. Isn't that supposed to be the property address?
Usually it's their mailing address. What you can request if they do, there's a description box at the bottom of the certificate. You can ask the agent to put in the location address. That's typically how we do it.
And if that box isn't checked at the top, where it says additional insured, is that a problem?
Yeah, because that means that they're not an additional insured.
Even if it's written at the bottom?
Well, sometimes people write it at the bottom. So again, it just depends on how the agent does it. Typically, I check it and put it at the bottom.
I can't tell you how many times I get it wrong.
Yeah.
You see,
We have insurance with, I'm right here, Atlas, and our premium came due, and it was quite substantial. I know this is a repetitive question for you, However, it red flagged the owner and they wanted to know why. And the complex is in excellent condition, no claims. They said it was because of the age of the roof. Now, to replace the roof, we have 6 buildings, so we're not gonna start replacing them until they start to leak. What, as a consumer, can we do to eliminate those spikes in our premiums?
Well, really, to be frank, if you have a new roof, what that usually does, that invites more competition. That doesn't necessarily say, oh, your premium's going down because it's a new roof. It goes down in part because mostly because of competition. So how to avoid it? We can go back to what I talked about. You want to make sure it's marketed everywhere. You want to make sure it's presented the right way. You want to make sure you're getting credits where possible. In a market like this, without having the building in front of me and all the applications, I'd love to help you out. We can talk after to make sure we maybe look at how it's handled. But there's not an unlimited amount of things that you can do.
Anyone else have a question?
I think just one more thing too, just kind of what we're going through on just market wise right now. With the hard market, I know Mark talked a lot about it, but one of the big things, especially in Florida, that's created an issue, a huge issue, is assignment of benefits and the litigation that results from that. What happens is when buildings, are damaged or not damaged, what was happening is you had some contractors, roofers that, maybe weren't using the best of morals, knocking on people's doors 2 years after Irma, going, hey, let me get up on your roof, take a look at it. If we see anything's wrong with it, we'll get the insurance company to pay for it. So there were all these claims. And by the way, they asked the homeowner to sign on the dotted line to sign an assignment of benefits contract that essentially gave all the rights of that homeowner's insurance policy over to the business owner, over to the contractor that was doing the work. So they have control of the claim at that point. The problem with that is they usually end up suing the insurance company, and that claim gets just ballooned to way more than it should have. And what happened just last year alone, there were about $15 billion in insurance-related lawsuits filed in Florida. Only 7% of the money from that went to the actual person that had bought the insurance. The rest was all attorney's fees and defense costs. So that's the biggest problem we have right now in Florida, and we need legislative changes to address those issues. And they didn't get done last session, so.
And by the way, when that person gets their new roof, oh man, that was so great. That's going to affect everybody's insurance costs. Like that has a big impact on everybody else.
I have a question about the pets. Have you seen any changes with the pets and what should be careful with the tenants and things like that? Like aggressive breeds and.
I haven't seen changes necessarily. I mean, it's hard. They may be a little bit more tough on that kind of thing. I actually have 2 American Bulldogs. They're pit mixes. They are American Bulldogs too. But I actually had who was Nationwide, who's our home insurance company. They actually flagged my account and said they were going to non-renew it for November 8th because we have aggressive breeds. I had to go back and tell them we have documentation of American Bulldogs, and then they said, okay, you're back in. I haven't seen a change, but that is sort of the game that they play.
Yeah, I would just talk to your vet in those situations too. Sometimes they can, word it a certain way.
Documentation.
On the flood insurance slide, you showed that there's the National Flood Insurance Program and the private flood market for policies and acquisitions when somebody's looking at flood insurance. Can we depend on the private market number, which may be lower when we're advising folks on what their costs are going to be year in and year out?
I mean, the one thing I would say about it, you can go with it, but they can also cancel those. That's one of the differences between the NFIP and the private market. So you can and you can't. It's not as reliable as NFIP as far as this will be your premium this year.
That was Tommy in your office said that to me when I just gave that advice. So I thought about that. He said, look, it's a gross lease situation for most of the leases. And so we were trying to calculate what the return would be. And he goes, you can use this. They've got the private market right now, but they're here until the end of that term, and then they could leave again, and they're notorious for leaving year in and year out. So that's just something I thought was interesting that I encountered regarding flood insurance the other day. I thought the group might benefit from.
There was a write-up in the Deductibles that say that if you're in the process of trying to buy a commercial property near the beach, that they're now saying that it's going to be hard to have coverage because they're thinking that the erosion from the sea sand and the salt water is causing the building to collapse. Do you believe there's some truth behind that?
I think, again, I don't know necessarily if there's gonna be insurance changes. I do think there may be some things that change the statutes, especially for, if you're talking about something similar to Champlain Towers. I think what'll happen is, Miami-Dade County and Broward County are really the only two counties that require a 40-year building recertification. So I'm interested to see what other, how that's gonna roll out in the rest of Florida, if they're gonna make legislative changes to do it or not. I don't necessarily think, that locations like that will be uninsurable. I just think that the market will be limited, so it's gonna be expensive to buy coverage, because you have less insurance companies willing to write the property.
Just a quick point on the flood insurance and 30-day wait. If there's a bank loan involved, they'll waive that 30-day wait period. So if you're just paying cash or it's just yourself, but if there's a loan transaction, that gets waived.
That's correct. Yeah.
Good clarification point. Let's put a round of applause together for our two speakers today. I know I put the picture for one person with the contact information for both Mark and Jason is on the screen. And thanks for sharing your expertise, your professionalism, and your knowledge with us. Okay, a couple of cleanup points. I want to remind everybody that every Friday, right here in this room, sometimes in that room right there, depending on the number of people we have a Friday marketplace pitch session. And those are back in person. It is, we are having coffee and donuts again. So if you haven't been out in a while, come out, listen to what people have, opportunities to put together transactions. I think I've done 3 transactions out of that meeting this year alone. So it does work. There are opportunities that get pushed out there. And please think about attending. Our next general membership meeting is August 17th. It's going to be on construction, specifically on construction pricing and timelines. And I think if you haven't gone through that process recently, it's changed a bit, especially the pricing. So we're excited about that. We're going to have Willis Smith. I think John will sit there from Willis Smith, and we're going to have a tenant rep in Fournier. I think it's Mike Fournier. So we're looking forward to that. Williams put that together, and that's coming up this upcoming August. Oh, Sarah Lynn as well, right? Oh, that's right. And Brett Henson, that's right. We're going to have a legal attorney as well. And then lastly, October 29th. Raise your hand real quickly if you have signed up for your foursome or golf. No one can raise their hand because I was told this morning that only a foursome from Henry Associates has been signed up on, okay? October 29th is the Friday before Halloween. We got a morning session. It's going to be really nice. It's afternoon session. Thank you, Matt. There's Matt. How come you haven't signed up? You know more than I do. So afternoon session should be a lot of fun. Please sign up now. That's a really good event. The charity that we're supporting for that is going to be Heroes Welcome Home, benefiting the vets and some of their opportunities there. So we are excited about that fundraising opportunity and the opportunity to get together. Thanks so much for coming out today. Have a great evening.